Thank you all very much for joining us this afternoon. We appreciate you carving time out of your busy schedules to join us for Building Exceptional RIAs. We've got a really full agenda today. I want to cover a couple of quick housekeeping items. This is a series of webinars, and the next one will be Bob Veres live. If you know Bob, he's been editor-in-chief of Financial Planning Magazine and Morningstar advisor. He's been an RIA insider, a key player for years and years and years. We're excited to have him on November 20th, and we'll be sending you guys some information about that. We're going to be recording today's webinar, so you will get a link by email when this is over. Probably tomorrow morning, check your inbox for the recording. And we'll have information about Bob. We'll have information about the recording for you in there. So we are recording this. If you've got questions along the way, if you'll look on the right-hand side of that GoToMeeting webinar box, you'll see a space for questions. Just go ahead and type those in. And we'll try to get to all of those before we sign off today. But we're on kind of a tight schedule, so if we don't, we'll definitely get back to you. So we're going to kick off with Marc Hurley. We're going to let him talk a little bit about his view of the brave new world for RIAs, and then we've got Michael Steer, the president of Adhesion Wealth Advisor Services, who's going to tell us a little bit about how that solution fits into this brave new world, and then we'll give you guys ample time for questions and answers before we wrap up. So Marc, take it away.
Well, thank you very much. This paper I'm going to talk about today, you can download for free from our website. We publish these things every 4 or 5 years and put them in the public domain. The website is fiduciarynetwork.net. That's fiduciarynetwork.net. You go on there and you can download it. It's about 85 pages. This study is one of a series of 3 that we've done over the last 14 years. In each case, we've tried to do is to take a look at where the wealth management business is at that point in time, what forces we see out in front of it and how we think it'll shape it, and then try to give some idea for industry participants on, at least from a macro level, how we think those forces may affect their businesses and also how it'll ultimately affect the shape of the industry. So for a starting point for this study, we took a look at where the industry is today. And this is a very large number of participants in the independent wealth management industry. There's about 19,500 or so firms, and it's extraordinarily fragmented, a variety of different business models. But the single best way to look at them, in our view, is to consider how evolved they are as businesses. And what I mean by the term evolved means how sustainable are these enterprises for the indefinite future. And you'll notice on the far left, we think there's about 200 firms in the industry today that have sufficient scale, but more importantly, have brought on enough successors, broadened the ownership, institutionalized the marketing, institutionalized the client relationships in such a way so that even if the founders literally drop dead tomorrow, the business would continue to march without any real hiccup. I want to emphasize, though, that size is a necessary but grossly insufficient condition for meeting this criteria. There are evolving businesses today that have $3 to $4 million of revenue, and there are firms with $10 to $12 million of revenue that are not. This has more to do with, quite frankly, how far they've evolved the business model. On the far right, you'll notice there are also firms that we would call books of business, and that's the predominance of the industry, about 18,000 firms. And in the middle, there are firms that have been able to achieve some material scale. However, they have been unable to or unwilling to evolve the business to date. I also want to emphasize that the criteria or the characteristics that we've described under each of these things are not really black and white. In other words, there are firms that, for example, are evolving businesses that need to do a better job in some of these areas, and there are firms, say, that are tweeners that have done a better job than what's shown here, but they still haven't quite evolved enough to reach the evolving business category. And similarly with the books of businesses as opposed to the tweeners. Now, looking backwards, how do we wind up with this structure? And if you go to the next slide, please. The industry got started at a very fortuitous time. For anyone who was in the business 20-odd years ago, they managed to catch a 3-part perfect storm. Almost overnight, an obscure tax rule change called Rule 401k made it much, much easier for companies to shift to defined contribution plans. This in turn made people responsible for their own financial well-being, and almost overnight created an immense demand for holistic, comprehensive advice as opposed to traditional brokerage services. There was a vacuum. There was nothing out there. Into this vacuum emerged very quickly a cottage industry. There was literally no competition for clients. And right at the same time that these small businesses got started, they caught the front end of the greatest bull market, equity market in U.S. history leading into the internet bubble, as well as they caught the front end of boomers saving for retirement. So they picked up many, many clients who every year gave them more money, paid them more money for not doing anything more. And as I say here, it was like a glorified pie eating contest. The second decade of the industry was not quite as easy because we'd have the same consistent bull market, although on average market did trend upwards. However, there was still an immense demand for the service that was unfulfilled, and firms, however, at this point had gotten to a certain size where they had to make some decisions as to whether to reinvest in the business or not. And if you make three general slices of where people are today, there were certain firms that said, look, I want to grow and I'm willing to take some of my profits and put it back into the business, but I really, quite frankly, want to milk as much of the profits as I can out of the business. And those firms today are tweeners. There are firms who said, we see the opportunity to build a great, large, sustainable business, and we're not just going to invest in the business, we're going to really extraordinarily invest in the business in such a manner so that we can build something that is sustainable. And those today are the evolving businesses. And the firms that were in the book of business category were ones that really the owners had a great income. They didn't really have to work quite that hard, and they were able to take out what they made every year and not have to reinvest much. And that's how, based on the decisions they made with regards to reinvesting and growth and evolving, decides kind of where they are today. Go to the next slide, please.
Hey,
now, going forward.
Mark?
Yes.
Do you mind if we do a short poll? I'm just curious where our audience thinks they fit. In this tweener books of business, evolving business world, where do you guys think your practice fits? And we've given you a number of choices. If you'll just take a second, this is one of the ways we can kind of hear from you exactly what's going on, what your reactions are to this webinar. It helps us dial in the content a little bit better in future meetings. Where do you think you fit? Do you perceive that you are a book of business? Maybe you're between book of business and tweener. Maybe you're a tweener. Do you perceive that you're between evolving? I'm sorry, that E should be evolving business. So E is evolving business. There's a typo on there. So where do you guys think you fit in this spectrum? If you'll all jump on real quickly, this is anonymous. We'll share the results with everyone. It's kind of enlightening to see where everyone fits. So E is evolving business. A is book of business. And then we've got 5 steps in between. So just a couple of more folks to vote. Let us know where you think you fit in this spectrum of evolving businesses. All right, cool. Let's go ahead and take a look at the results here. All right, kind of interesting. 30% of the folks we're talking to today, Mark, are in that evolving business model. 25% perceive themselves as tweeners. 25% perceive themselves as between a tweener and an evolving business. Pretty interesting, don't you think?
Yeah, well, you mentioned there were some firms that were reasonably material that are on the call, so that's not surprising.
Okay.
Now, if you go to the next slide, there you go. What's going to change things going forward? Because all we've done so far is sort of look at where the industry is and how it kind of got here. And we see 5 rather major forces that will reshape the industry. First and foremost, as I mentioned, the previous 2 decades have largely been a land grab in terms of capturing clients. And currently the pool of prospective clients who don't have advisors is growing relatively slowly. If you go to the next slide, please. If we had made this slide starting with data in 1995, between 1995 and 2007, the pool of prospective clients grew 90%. There's demand for the service grew at such an incredible rate, and this is an industry where every firm has a finite capacity to add new clients because there's such an enormous amount of work done with new clients that you can see why the industry was relatively easy. to succeed in, simply because the demand for the service was just growing at an extraordinary rate. Now, if you look at this data as well as the BCG data, the statistics they've come up with suggest that the pool of prospective clients today is still smaller today than it was at the end of 2007. And we do have a reasonably anemic economy with extraordinarily low workforce participation. At some point, hopefully that will change. But if you go back one slide, please. But what's going to be different going forward is that in the first 2 decades of the industry, you had small firms competing with other small firms to capture clients. Today, I mean, I can remember a decade ago, if someone had $200 million, I mean, oh my goodness, they were just, everybody wanted to touch them. They were so wonderful. Today, if you got $1 billion, you're fairly midstream. You know, it's commonplace. There's probably 300 firms that have $1 billion under management today. And as these firms have gotten larger, they've become much more capable at marketing. So we're starting to see the first vestiges of actual competition for clients. Where before simply saying you were a fee-only wealth manager was distinguishing, now everybody either is a fee-only wealth manager or at least pretends to be. And there are obviously pockets where people can get clients more quickly, namely anyone who happens to be down the street from Facebook probably had a pretty good run at some opportunities recently. But reality, we think, is that the client gathering function is going to cost a little more and be a little bit harder going forward. Now, at the same time, there's a subtler, more powerful shift occurring in most wealth management firm client bases, and it has to do with demographics. You know, if you had a client that you picked up 20 years ago, today is 20 years older. That's sort of a tautology. And generally, when you pick up clients, they tend to be still in the asset accumulation phase, so they effectively give you more money each year to manage, i.e. pay you more when you don't really do any more. And then at some point, that reverses itself. And at about the point it starts to reverse itself and clients begin consuming, they also get to a point where they become more risk averse from an investment standpoint. So consequently, the appreciation on the assets over time is slower than it would have been in earlier years. And it's literally a mirror image to what this industry had when it first got started. Now, this is unfortunately occurring at an odd time in U.S. financial history. And what I mean by that is that the Fed is, as everyone knows, is literally printing money. And the Fed, what treasuries generate in returns are the benchmark by which all lower risk asset classes are compared. And so we're at a period now where all lower risk asset classes are producing substantially lower returns than their historical averages, both on a nominal and a real basis. And this is happening right at the point that more and more clients who are getting older are shifting assets into these lower risk asset classes. And this results in greater net capital consumption. Now, if you skip 2 slides forward, please. To give you a sense of what this means is if you looked at a typical firm that's an evolving business firm today and you did a revenue-weighted average age, in other words, not just simply demographics, but demographics by revenue, most of the evolving business firms you've looked at, they would look somewhat similar to this. What happens, though, over time is if they continue to add clients at the same rate that they're adding clients today, if you skip to the next slide, please, this is what the client base looks like. And literally about half of their clients wind up in a function where they're starting to consume parts of their capital and take less risk with their investment assets. And the combination of those two things reduce the rate at which revenues grow. So you have 3 forces that are going to kind of, in aggregate, hold back the rate at which future revenues grow. I mean, firms will still be able to add clients. It'll just be a little harder and it'll cost more to do it. Number 2, their clients, as they get older, are going to see their assets appreciate less and they're going to begin to consume them. And again, the third thing is this is happening right at a period of time where low-risk asset returns are at record lows. And granted, we have had a roaring equity bull market, but if you actually look at diversified portfolio returns for most advisors, they're nowhere compared to the types of returns they had back in the 90s when we had this roaring bull market, because their lower-risk assets weren't yielding 1 or 2%. Instead, they were substantially higher. Now, on the next slide, the fourth force that's happening right at the same time that these 3 things that are slowing down revenue growth is that costs of the industry continue to go up. The single biggest reason why is that there is a chronic shortage of young people in the industry. Russ Allen Prince has argued there's only 22% of the people who are under 40. I've seen statistics that are similar to that. They look at the FPA membership, 60% are 52 years or older. And what it means is that for people, more and more people are getting ready to head out of the industry. There are fewer to replace them. The only real leverage in these businesses is by adding younger professionals who are both trained and qualified, and that takes a long while to get somebody to that point. And net effect is this supply demand is pushing up cost inflation. And while most wealth managers we looked at are averaging around 5 to 7% general cost inflation, which is fairly substantial given that we're in about a 1.6 inflationary environment, 1.6% inflationary environment. The labor costs are going up between 7.5% and 9% a year. And if you want to get a feel for this, if you had someone counting salary and benefits and everything all in was making $150,000 a year, and over the next 5 years you thought that might rise to perhaps $225,000, that's about 9% inflation. And that's the real driver here. But additionally, everyone is well aware that the regulatory environment has gotten much more adversarial and has become requiring a lot more resources and time of management. As I mentioned earlier, differentiating oneself from a marketing standpoint is becoming a little more costly, and every firm I've talked to is having to spend much more on lawyers just to protect themselves from litigation risk. The fifth force that's going to reshape the industry is that the people who started these businesses are starting to get relatively old. The average age of a founder is somewhere between 59 and 62, depending on the data that you look at. For most people, this is the preponderance of their net worth, is their equity in their company, and many of them are beginning to look at doing their own financial planning. If we go to the next slide, please.
Hey, Mark, do you mind if we ask another quick question? For the guys that are on the phone, which of these 5 forces are you feeling yourselves now? Which of the 5 forces are you feeling? Are you feeling more in the terms of competition? Are you feeling this aging database as a reality in your practice? Are you feeling the pressure from lower returns? How about the cost inflation thing? Are you one of those aging founders? Tell us a little bit about where you are, and we'll share that with everyone else. Which of these 5 pressures are you feeling most? Is it competition, the aging database? Is it the lower returns? Is it the cost inflation? Is it the aging founders? Thank you all for participating. As I said earlier, this is anonymous. If you've just joined us, this is being recorded, and you will get a link to be able to download the recording a little bit later. Just a few more of you to jump on, and then we'll close out the poll. Outstanding, thank you. So here's the results. And Mark, 35% say they're feeling the pressure of the competition. Cost inflation and aging founders get about 20% each of the share. Is that kind of consistent with what you're seeing in your travels?
Yeah, well, as I say on the next slide, what happens is each of these things on their own are not enormous changes in the business. But in the aggregate, particularly excluding the aging founders, the first 4 in the aggregate, the combined effect of that are quite substantial, and they're fundamentally altering the forward-looking economics of every firm. And I want to emphasize that it's extraordinarily hard for someone to completely get their head around some of these issues because they're very different going forward than they have been in the past. I mean, just one issue alone. When one goes from having predominantly asset accumulators to people who either stop accumulating or begin consuming, and also as a result modify their asset allocation somewhat, the effect of that on one's revenue growth is quite significant. It's just very hard to see because it's not static. Every year it changes just a little bit. And if one continues to add clients at the same rate on an absolute basis, not percentage, but the same number of new clients every year, over time the center of mass of the client base shifts very far to the right. It's simple mathematics. And if you go to our next slide, here we go. All right, go back to the one before that, please. Now, the aggregate effect of all this that we're talking about here is there really is no more easy money to be made. In other words, look, everyone works hard. There's a lot of smart people in this industry, but I have yet to speak at an event where I haven't asked people, does someone here not know someone in the industry you think was an idiot who's been successful? Now, everybody knows somebody. They go, how did that guy ever succeed? And that was really a reflection of the fact that you're in such a benign environment. You didn't have to even raise capital, and people could build businesses that were both very profitable and quite valuable. And going forward, the operating environment is very different. As I mentioned, the individual changes on their own are not that large, but the aggregate effect is going to change everybody's economics. What ways one can respond to this, quite frankly, depends on how evolved the business model is. And what is very, very hard, we have found, and we interviewed many quite successful firm owners, is just how much this does change the economics. There's a professor who won the Nobel Prize in economics called Dan Kahneman, who's actually a psychologist. And he speaks to the fact that the way people actually take in information and analyze it is they don't sit down and take all this information and then make a rational decision, but rather what they do is they start from a reference point and then they apply the information against that. It's called anchoring. And the dilemma for most people in this industry is that a reference point has been 20 years of an operating environment that's quite different. And so we encourage everybody who owns a firm or is an owner in a firm is they've got to do a much better, more robust analysis of what their forward-looking economics look like. We call it a trajectory analysis, where you have to look at multiple factors. Look at how client demographics are going to shift over time, how that will affect their asset allocation, which in turn will affect their appreciation and their consumption. Take a look at how the cost structure is blended into this, and come up with a much more dynamic model. Now, we have some examples of that in the study we've done on some firms. But every time we've done this for a firm where we were doing the research, the owners were astounded because people sort of think, well, okay, maybe things are not going to go up as much, but they'll still continue to trend in a certain direction. And the reality is when all these forces hit at once, that no longer continues. Now, if you go to the next slide, please. As I mentioned, the firms that are evolving businesses have the greatest number of options to address this, but this is also a real crisis for them. What an evolving business is we have multiple generations of owners, and the whole premise of this is you're going to attract some extraordinarily talented people to the firm by giving them such a great opportunity to work there and, quite frankly, build their own net worth, while at the same time meeting the founders' ambitions. And the people who built these businesses have succeeded because they are quite ambitious. Now, you talk to one of them, and they would say, well, I've got $10 million of revenue today, and 10 years ago I had $4 million, so that means, quite frankly, I should have about $25 million of revenue a decade from now. Well, that's not really how it works. You add clients one at a time, and then if you execute as well in the forward-looking 10 years, which is going to be a lot harder because this will be a more difficult environment than one did in the previous 10 years, your revenue should be about $16 million and not $25 million. And by the way, your margins should be substantially less, which means maybe your earnings would grow, 5% a year. We think that if one does the three things I'll talk about in a second that every firm probably should think about adopting in some fashion, growing 5-6% a year is very doable. We think the real challenge is getting it higher than that. And this is problematic for two reasons. Really, really talented people join these firms because of the size and scope of the opportunity. And if the pie is only growing 5% a year, that opportunity is not going to be that as compelling. It's much easier when you're growing the pie 10% a year. And equally, if you're the founders, you're going to have to increasingly share more of the pie, so your outcomes are only going to go up about 3% a year. Now, granted, it's still a great business to be in and everything, but this is a real crisis when you have people who are ambitious and smart, and the evolving business firms are dominated by these kinds of personalities. To get a sense of how this might have looked, sort of go back 10 years and look at a typical evolving business firm and see what its trajectory and client base would have looked like a decade ago, and sort of compare it where it looks now and then what it would look like going forward. So if we go to the next slide, please. A typical firm that we've looked at a decade ago, this is what their client base demographics versus revenue would have looked like. And if you did a straight line trajectory, in reality, nobody travels in a straight line. It was kind of bumpy. If you go to the next slide, what you'd see is if you ran the math on what they could do if they'd done some planning back then, they could have achieved both the end point on this. It would have been much more volatile, but this would have been their actual planning strategy. They could maintain their existing gross operating margins, grow the revenue 2.5%, and grow the profits, 2.5 times, and grow their profits 2.5 times, which is about a 10% earnings growth rate. Now, that's the good news. The bad news is, if you go to the next slide, their client base today is a little bit older than it was before. And this has a real impact when you do sort of a forward-looking operation. The other problem is that because they're being hit by these other forces, cost inflation, slightly slower growing lower risk assets, and some consumption from some of the older clients, if they continue to add clients at the identical absolute rate that they have been doing in the past, their trajectory going forward, next slide please, looks like this. And the key line to look at is the solid line, which is their profitability. They can continue to grow their revenues. The crisis they're going to face is that they're going to have profitability is going to be basically flat. If you go back 4 slides, please. The crisis they're facing has to do with the fact that wealth management firms have this natural governor on their ability to grow. Now, this firm that I've shown here, this example firm, they've been adding 30 net new clients a year. And for them to grow their earnings at 10% a year, they would have to add about 64 net new clients a year. What's problematic about that is that in order to add 64 net new clients, their costs, instead of going up 5% a year, would have gone up about 8.7% a year. Well, if their costs go up 8.7% a year for their earnings to grow up 10% a year, they now have to add about 85 clients a year. Well, if they add 85 clients a year, they have to now grow their expenses north of 9%, closer to 10. Well, that would in turn mean they would need to add like 90 clients a year or 95 clients a year. In other words, it's this upward spiral. And what's the source of this problem is that wealth management firms have an economic model that's very different than any kind of other investment management type business, in that they use about 15 to 20 times the resources on new clients than they do established clients. Consequently, in other words, a client shows up, they got a shoebox full of insurance policies and mutual fund statements, etc. And an advisor spends the first 18 months working with the client, helping the client make a series of very important decisions and effectively getting the client set up. Now, after that 18-month period ends, the advisor makes a tremendous amount of money off the client because it's sort of tweaking the thing at the margin. But the fact that it takes so much resources up front caps their ability to take new clients at a certain number at one time without dramatically changing their cost structure. If you want to get a sense of this, a firm today that has 400 clients could probably have 200 more established clients and really not have that much change in their cost structure. But if a firm with 400 clients had 100 new clients show up on one day, they could not take them. They'd be so overwhelmed they'd never catch up for 2 or 3 years. This is the dilemma. It's wealth managers can advise enormous volumes of established clients, but have a very finite capacity for adding new clients. And most of the evolving businesses have gotten to such a size they effectively have a governor on their growth on a relative basis, but their costs keep going up on a relative basis. And this is what's creating the margin squeeze for firms. Skip forward 4 slides, please. One more, please. Now, what are the choices if you own one of these businesses? Well, one obvious thing is try to become a little more efficient, and most of the evolving business firms already do this reasonably well. They outsource most of their low value-added functions to custodians and things like that. But the real thing you remember is what one owns with a wealth management firm is an intellectual capital factory, and how that time of the key people is used is the biggest determinant of productivity and efficiency. A lot of firms track the time very carefully. There's even one firm that's done extraordinarily well. For every senior professional, they have 2 administrative people, and they expect the senior professionals to spend 80% of their time in front of existing or prospective clients every day. But at some point, there's a limited benefit to becoming more efficient because you're getting a smaller percentage of a smaller number every year. And so this on itself will not solve anything. It's just something that every good business has to do. A bigger thing that many firms have now done, and it's become the hallmark of most evolving businesses, is to reallocate the risk of compensation. In the first 2 decades of this industry, it would have been irrational for most owners to even think about trying to give away upside because you had such an upward trending function. The most rational strategy strategy would be to try to keep as much of the upside for yourself and have a greater portion of your cost to be fixed. Now that we're in a very different environment, what you're seeing the best firms do is they're changing their compensation structure so that what people get paid is increasingly tied to profitability. But you're going to have people have more downside, you have to give them more upside, and there's much broader ownership in the organizations. And we see this is a key trend in effectively reallocating risk. And the best firms out there, their successor professionals are taking somewhere between 30 and 50% of their comp is their distributions on their ownership. They're completely aligning the interests of the employee with the other owners of the firm by making them owners, and then making more of what they actually take out of the firm tied to the basis of their ownership. The third function that is, I think, going to be a very dominant factor in the industry and has not been to date is you're increasingly going to see wealth managers become specialists. And what I mean by this is that when a client shows up in front of a wealth manager, the real value of the wealth manager is not investment management. That's actually a commodity that has a negative convexity. If one does a great job, one doesn't get more clients, and one does a poor job, they blow their whole business up. The reality is the core value-added wealth managers are what I would call the diagnosis function. Meyer Statman at UC Santa Clara has written about this. He describes advisors as financial physicians. But what the job of the advisor is, when a client shows up, they know more about the issues the client should be worried about than the client even knows exists. And it's through this 18-month setup process, they help them organize their lives and their finances to solve their problems. What specialization is an exercise in being an expert at solving some extraordinarily complex problems held by a small number of people. And ideally, in any sort of specialty business, you try to corner the market. A great example of a firm that's an extraordinary specialist is a firm we're an investor in Phoenix. It's a firm called Keats Connolly, and they've built an expertise in helping Canadians who sell their businesses in Canada to immediately emigrate to the United States and pay no taxes either side of the border on the sale of the business. It's completely legal. It's consistent with the U.S.-Canada tax treaty. There are more than 100 bells and whistles. It's extraordinarily complicated, but it's the core of a real specialty in that while many people could give someone great financial advice, this is the only firm in the country that can actually solve this problem. And what we think you're going to see are more and more firms develop these subspecialties and effectively become confederations of specialty businesses as opposed to offering simply a generic service. If one does the first three things, we think you can grow your earnings at 5, 6, 7% a year, indefinitely. But again, the question is does that meet both the ambitions of the founders and keep the successors happy? And for many of the firms that have done quite well, this is a borderline crisis, quite frankly. Now, what we're seeing in response to this is the other alternative one has to try to boost earnings is through acquisitions. And all an acquisition is acquiring another wealth manager, but from an economic standpoint, what you're picking up is a block of established clients and some additional qualified successor professionals. And effectively, you're front-end loading 5 to 7 years of organic growth in a single function. And we've seen more activity on the M&A front in the last 8 months than we have seen in the previous 6 years combined. Next slide, please. Now, for those firms that are tweeners, first let me tell anybody on the phone who's been running a tweener, they have had the singularly most brilliant personal economic strategy since the start of the industry. The idea here has been you have a business that throws off a lot of cash flow. How do you reinvest the absolute minimum necessary so you can maximize the profitability of the business and still grow? And there are owners who've done this. I've run into 2 owners over the last year or so that have individually made in excess of $25 million after tax over the last 20 years doing this. So we're talking, they've done extraordinarily well. The dilemma for these owners is that the model they've used is soon going to be unsustainable. And what may not be as apparent to many of them as it is to someone who's studied this closely is that the reason why the model worked so well wasn't simply that you were able to get clients and service them at a low cost. It was that your business was being subsidized by the fact that the preponderance of clients you were getting were asset accumulators. And as they shift gradually into the function where they are capital consumers, what happens is the revenues of the business actually start to decline. And at the same token, these businesses operate at such extraordinarily high margins that it's very, very hard to increase the margins. We run into a firm that has 86% operating margins in one case. So the alternatives that are available to evolving businesses really are impractical. As I mentioned, their margins are already so robust they can't get that much more efficient. They are unable to got that off there. Yeah, they are unable to really alter their comp structure, because their comp structure is their whole raison d'etre of the model is a way to maximize profitability. And these firms, while they have some successor professionals, the successor professionals typically are people that are much more caretakers rather than of the quality that are necessary to build specialty businesses. And lastly, the businesses themselves, they've reinvested so little they couldn't support an acquisition transaction. So one owns one of these firms. Like any other business, is sort of caught in the middle of an industry that's about to undergo a next stage of its evolution. There are three choices: you either move up, you move down, or you sell. Those are the choices. And there are about 30 to 50 firms that we've identified that are making the move from being tweeners into evolving businesses right now. The second option, which is to sell the firm, there are firms that have looked at this, but we think most of the firms in the industry that are tweeners today are going to devolve into books of businesses. They're slowly going to see their margins crushed. And the big reason for that is that this option to sell is not one that's going to be out there indefinitely. A buyer is looking at a wealth manager from two perspectives, both the attractiveness of the business and, equally important, the materiality of the business. And what I mean by the latter is that if I'm a firm, say today, that a tweener that has, say, 3 or 4 million in revenue, a firm that would have 6 or 7 or 8 million in revenue, I would be a potentially attractive acquisition only because I'd be material to them. I could actually substantially increase their profitability if they could successfully acquire me. However, if that same business gets up to 20 or 25 million dollars of revenue, unless the seller's in a market off by itself and someone wants to get into that market, this firm is going to be quite immaterial for an acquisition, and it's really not going to be worth the time or trouble. If you go to the next slide, please. So to get a sense of this for firms that are tweener firm owners, this would be a more typical tweener firm demographics. And while every firm I've talked to think their client demographics on a revenue-weighted basis look like the evolving businesses, when you actually go out and plot it out, firms that have consistently added the same number of clients since inception on average, round numbers, will look like this. They've been around for 20 years. And this is consistent with several tweener firms we've seen in our research. Now, the same firm, if it continues to add clients at the same rate that it's adding them today, not in 10 years, but in 5 years, will look like the next slide. This will look at their client base. And this looks like a headache for someone else to take over as opposed to something compelling, because all you've picked up is the preponderance of the revenues of the clients are people who are old. They're going to basically pay you less every year for doing the same amount of work. Additionally, for the owners, the reason why we think there'll be so few deals that'll get done is that the tweener owners most of them have done any kind of real detailed analysis. So when you ask them, they'll say, well, I'm making, $3 million a year now or $2 million a year now, and my goodness, worst case, I'll make $1.5 million in 10 years. The reality is, if you actually look at the demographics of their clients and you look at all the other forces that are affecting them, if you go to the next slide, please, this is a more realistic trajectory that in 5 years they're going to have nothing to sell. And this is why we're relatively pessimistic on the number of deals that get done. I know you've seen many investment bankers and other people who are trying to find business, FP transitions, people like that are saying, oh, there'll be thousands of deals done. No, they're not. And the reason is most of the sellers who should be selling, in our view, will wait too long until either the business is unattractive and or is immaterial to a prospective buyer. Next slide, please. For the firms that fall into the book of business group, I wish I had some cheerier thoughts to tell you, but one should expect that, as these forces take effect, you're not going to go out of business. You're just going to make less money, and it'll get harder to get new clients. And the business itself don't have really the money to reinvest in a more dynamic sense. So the business will continue, but they'll be like a local bookkeeper or even a barbershop. They'll be around, but the business itself won't have a lot of value. There is an urban legend that's been propagated out there that, oh my goodness, there's all these buyers for these firms, and in reality, they fall into one of two categories. They either tend to be firms that are trying to do roll-ups with no cash, i.e., give me your business and I promise I'll give you something in the future, but in the interim, I'll give you some stock in my business, or B, the way someone's buying them is they're giving them money, but the overwhelming preponderance of it is contingent. So from an economic standpoint, it looks much more like getting a referral fee. It's not really consideration. It's not anything material. Next slide, please. So what do we think this means for the future of the industry? Well, next decade is going to be quite different. You're going to see competition, not just for clients. We think in some ways there'll be more competition for employees. Clients are older. Returns may not be as robust as they've been, but clearly the businesses are going to be much more complex. And while it's going to be a harder business to be in, we'll still think it's an incredible opportunity. However, business strategy and management competence are actually really going to matter, and they're going to provide competitive advantages. And you add to that the demographics of many of the owners of some of the industry's longer-term participants are getting to a point where they're going to have to do something from a strategic standpoint, or they'll watch their business dissipate. We think there will be some acquisition opportunities. But we don't think the industry is going to consolidate, and Jack mentioned that Veris is going to talk soon. He and I love to debate. I have a standing bet with him. If he can show me anywhere that I said the industry is going to consolidate, I'll give $1,000 to a charity of his choice, and he's never been able to collect. We think the industry is going to concentrate. And what I mean by that is that the bigger firms are going to get much, much bigger, and most of the assets are going to wind up in a relatively small number of firms. We don't think firms are going to go out of business. We just think the big firms are going to get quite bigger and very, very valuable, and most of the other firms, they're going to be, jobs more than anything else. So if we had a guess, and no one knows this with certainty, our view is that you'll see 25, 50 firms are going to get quite large. We know of 6 firms now that are north of $50 million in revenue. We think there'll be 25 to 50 that'll be north of $75 million a decade from now, some as much as $150 million in revenue. We think there'll be some mergers between evolving businesses. We also think there'll be some of those evolving businesses do acquisitions. And even the evolving businesses that don't get to the quite large size, we think will be larger than they are today, and quite frankly, we think they'll be much more specialized. And then there will be thousands of books of business. The group in the middle, which is the most interesting group, the tweeners, we think about 90+% of them will become books of business. Only about 100 to 125 will actually get acquired, and a relatively small percentage will actually move up. Next slide, please. And if you want to look at what the industry will look like at 30,000 feet 10 years from now, this is what our guess is if you want to take a snapshot of where the industry would be. Now, the obvious question is why so few acquisition transactions are going to occur. And if you go to the next slide, please. There's a variety of reasons why there won't be that many deals done. And you can see the numbers we would guesstimate will occur by these different categories. The biggest reason why banks will not be great acquirers is that what normally happens in any sort of bank crisis cycle is a number of small banks are put into receivership. The small banks that don't go into receivership become much larger banks. And then after the crisis is over, there's a series of new banks that are de novo banks that are chartered by the FDIC. And until recently, and we went through the same cycle through this financial crisis 2008, 2009, but the big difference was until recently, the FDIC had only chartered one new de novo bank in the last 5 years. And what this means is that the banks that would be small banks before are now mid-sized. I mean, there's a firm in our market that had a $200 million market cap, and now it's a $2 billion market cap. And the wealth management firms, quite frankly, are not material to them. It's just they're not, buying something where you can make $1 million, $2 million doesn't move the needle enough to be even bother to try. So we'll think there'll be some bank deals. It may be 10 to 20. The roll-ups, and I'm happy to answer questions on this later. The roll-ups, and one in particular everyone knows about, the biggest problem they have is that the way their structure is set up, if one actually does the math, the common stock that they use as part of the roll-up is really worth close to zero. The businesses themselves generate cash flow, but the way their economics and their capital structure is set up, the overwhelming preponderance of the economics are going to go to the outside investors who sponsored it, as well as to pay off the debt associated. There's one out there right now that if you do the math on it, in 4.5 years, the first $720 million of value, if it could ever get public, which I doubt, is going to be consumed by the debt and by the preferred shareholders. And then well less than half of the stock is held by the firms that were contributed into it. So what they're going to get is very little. We've noticed that sellers have figured this out. And so what they're doing now is when the roll-up tries to buy them, they say, look, I think my business is worth X. If you give me X in cash, I'll also take some stock. They may have to negotiate it that way, but that's really what they're saying, and because they've figured out the stock is worthless. And what this does is it limits the capacity of roll-ups to do deals because they only generate a certain amount of cash each year, and we think they'll be able to do 3 or 4 deals a year, probably indefinitely. But that means you'll have maybe 30 to 40 firms get acquired by roll-ups over the next decade. The most logical buyers, bar none, are the independent wealth managers because they can acquire something, strip out a lot of costs, dramatically improve the profitability, accelerate their evolution. For 3 reasons, we don't think you're going to see a lot of deals done, though, between wealth managers as a percentage of the industry because, first and foremost, the tweeners or owners are very, very unrealistic, and they're going to wait too long to try to do something. The people who are owners on either the buy or the sell side are completely inexperienced in wealth management M&A. I've worked in M&A for 28 years. I can assure you wealth management M&A is some of the most complicated M&A you'll find in any field because there are no tangible assets. And as I say here, it's watching a wealth manager try to buy another wealth manager is like watching 2 virgin porcupines try to mate. They can get it done, but there's a lot of obstacles in the way. And then lastly, what really makes wealth management deals insanely hard is that no buyer gives a rat's hairy tail about the seller. What they care about are the successors because they're trying to keep the clients and over time generate sufficient amount of profitability from the acquisition to justify its cost. Well, this means that every deal is a 3-handed negotiation, and that's very, very hard of any kind of 3-handed negotiation is extraordinarily hard to get done. If you go to the next page, please. So last thing I'm going to touch on, and then I'll be happy to take questions from any of you who'd like me to. People have asked us a lot of what is current pricing for wealth management M&A firms right now. This is not in the paper. We would say it's, as we say here, it's neither a buyer or seller's market. There are buyers and for every firm out there, and there are many, but the problem is there's usually only 1 or 2 that make any sense. The best and most logical ones are wealth managers that are geographically proximate. They can by far pay the most, and they quite frankly can keep most of the clients. And we're at a point now where I would say is efficient pricing. And what I mean by that is that we've worked with firms that historically have been interested in doing acquisitions, have attempted to do acquisitions. They understand where the pricing is now, and they're of a view that they're either buyers or sellers at this pricing. And they have to get bigger or they should sell. And so we've actually seen firms that were on the buy side of a transaction, 2 instances recently, which have now gone to the sell side. And to me, that suggests we're at a point where intrinsic value is being reflected in the price. It is very hard for many acquirers, though, to get their heads around this because they've never raised capital. The dollars involved are so substantial, there's a bit of sticker shock, and most of them have never really taken any risk. I mean, they hung on a shingle and people showed up, was when they got their businesses started. And we encourage people to think about is not what you're paying, but rather what you're making on a risk-adjusted basis is how you should think about these deals. So to go to a real live deal example, we've changed a few things, but not much. This is a real live deal that's in the market right now. You got a seller that's relatively attractive. The client's demographics are not too old. They've got some successor professionals they could bring over. The seller has $5 million of annual revenue, and before the owners pay themselves a penny, the business makes about $2.75 million. The buyer's an evolving business, about $6 million of rev, about 50% gross margins. Their margins are skinnier because they're reinvesting more back in the business. They are geographically proximate. As is typical in most of these types of deals, they believe they can get a 70% contribution, which means on a $5 million of revenue, their incremental profitability will be about $3.5 million because they can strip out some costs. And they're highly confident they keep most of the clients. For this type of a deal today, if you went by one of the rules of thumb that all these self-anointed expert investment bankers or consultants say, they would say, well, you can aggregate, maybe get $10 million for the firm. Well, no, not really. It's usually $10 million on the downstroke and $5 million more if you keep the clients, and an earnout, which in this case, this example is up to 7.5, but I've seen the earnouts go as high as $25 million because that's all based on future growth. So in other words, a firm that has $5 million of revenue, they could, in this example, get $22.5 million of consideration. In other words, capital gains treated consideration. And I've seen as high as 40 in certain instances, depending on how dynamic the firm is. Now, someone would say, oh, my goodness, you need a saliva test to pay these kinds of prices. Well, not really. If you go to the next slide, the way the buyer will look at this is that the amount of pre-tax dollars that they're going to collect, and granted they're paying the other part, they have to use after-tax dollars to pay consideration, but the amount of pre-tax dollars they're collecting, if they just keep the clients and the thing market appreciates on average about 5% a year, is closer to $20 million, and they're putting out $15 million. Now, granted, they're still fairly far behind because they're using after-tax dollars to pay consideration, but they can use permanent capital and some term debt to fund these deals, and that allows them to sort of bridge the gap with that. And after they're done, their profitability is about $4.6 million higher. To pay for that capital, they've probably given up $1.5 million, $1.75 million of that 4.6. So effectively, they've doubled their profitability in financing by doing the acquisition. And this is why we're seeing a tremendous number of deals come to market, because there are buyers who figured out they can access the private equity and debt markets to finance these things. The sellers can get a robust price for their business, but at the same token, the buyers can still make enough on a risk-adjusted profitability basis to make these things make sense. That is my last slide. I'm happy to answer any questions anybody may have. Oh, I'm sorry, there's 2 more slides. If you go to the next slide, please. We've included in the paper a separate chapter, which I'm not going to get into much detail, which is it looks at the issues of you're either going to be a seller or a buyer. How do you be more sophisticated about doing that? Sellers have to recognize that this is much more than selling their business. This is a life passage, and the typical seller is more emotional than a pubescent teenager during the deal. They quickly realize that the only thing that matters is not their assets or their revenues. It's what will the buyer make off the deal. That's what he's going to base his pricing off of, and what's the risk-adjusted amount they'll make off of that. And what they try to do is to be as transparent as possible and to help the buyer fully understand what's going on in their business, because the buyers overcompensate for rapid assumption of risk and overpay for slower assumption of risk. The next slide, the smart buyers, they figure out that this is an industry where all commercial activity is predated by relationships. So many of these prospective buyers are already out trying to build relationships with the many firms they possibly can touch today, because they recognize they may be sellers at a future date. And they recognize that the process, while everyone has to pay a full price, the prices line up from all the bids. They're very close in every deal, so price doesn't determine it. The deals, in fact, are far more about success, is far more about psychology than it is finance. You're going to have to pay a full price. You're going to have to get a lot of capital to do one of these deals. If you can get a deal done, though, you make a tremendous amount of money. But what's going to be more critical is the whole psychology of getting the seller quite comfortable with you and feeling comfortable that they'll be successful, because in every deal, an enormous amount of the consideration occurs after closing. And so the seller has to be confident they're going to have a reasonably very good chance of getting that incremental money. Otherwise, the deal doesn't make sense. That's my last slide. Happy to take any questions.
Sure. Great job, Mark. Hey, folks, if you have a question, you'll see the question box on the right-hand side of the GoToMeeting toolbar. We'll take questions, and once we're finished with those, Mike Steer is going to do a quick overview for you of the adhesion product. Mark, we've got one question that's popped up. Are you taking into account the fact that financial advisors are retiring at a rate much faster than new advisors are coming into the industry?
Yeah, I think that's one of our points. We think we've got a real demographic time bomb, and it's driving costs up very quickly for existing firms. An economist looked at the industry. They would say, oh, my goodness, you're going to have 1,000 deals done because it's the only rational behavior. A psychologist who knew many wealth managers would suggest that no deals would ever get done. The people who started these businesses are entrepreneurs, which is French for a little bit nuts. And we believe the truth lies somewhere between the two extremes, probably a little closer to the psychologist than the economist. Also, if anyone has any questions of me directly, you can reach me either through email at hurleym@fiduciarynetwork.net, or you can call me in my office, 972-982-8705.
Awesome. Thank you very much, Mark. Looks like, wait a second, we got one more question here. You get the long questions, I guess. When looking at the, again, aging client base, did they take into account the management of assets that are passed on to beneficiaries, siblings, children, grandchildren, the concept of legacies?
Yeah, I think one of the myths in this industry has been that the way you are able to ensure that you have a fabulous revenue stream is by getting the children to be your clients ultimately. And the reason why I would say that's a myth is that may work for quite larger clients, but the typical client of wealth managers is the millionaire next door, the $1 to $20 million kind of client. And the bigger effect on the economics of these firms isn't whether ultimately the clients of the children of the client become clients of the firm. It's how much money is left when the time that the person dies. Now consider the macro forces that are affecting anybody who has any money. Social Security's broke. At some point, we're going to have to address Medicare reform, and what you can be metaphysically certain of is people with money are going to pay more personally for their health care. And this is all happening at a time where people are starting to live much longer. If we have half the breakthroughs they're talking about on the cancer side, and then some of the treatments are coming for Alzheimer's, you're talking about life expectancy very quickly creeping north of 90. And if you're a wealth manager, what you're going to see is it's not really their kids are going to matter, it's how much of their capital they're going to consume between now and the time that they die. We think that's a far more dominant variable than simply saying, well, whatever's left over, the kids will get.
Great point. Great point. So, Michael Steer with Adhesion Wealth Advisor Solutions, I think you've got some ideas to help these firms with their growth and efficiency.
Thank you, Jack. I appreciate that. I wanted to welcome everybody to our webinar series on building exceptional RIA firms. And many thanks to Marc for joining us today, for sharing his findings and insight. Some of it's definitely thought-provoking, some controversial, and as we heard, Marc has some pretty definitive views on the direction of the industry. Whether or not you fully subscribe to his complete future view, and we've heard he's had some nice debates with Bob Verries, who's doing our next webinar series, I think we can all agree that there are tectonic shifts that are reshaping our industry. I mean, we personally here at Adhesion evaluate these dynamics and discuss how to evolve our business and services all the time, and I'm sure you all do that as well. So within this context, I wanted to spend a few minutes in introducing Adhesion and how we partner with advisory firms to help with the evolutionary path that they've chosen to take. So, who we are, at the core of who we are, Adhesion is a comprehensive investment delivery solution for advisors. If you walk away from this brief overview today, which is one thing to remember, it would be this slide. From the outset, our exclusive focus has been on delivering a service model tuned specifically for independent wealth advisors. And I make that contrast specifically to other options that are out there, whether they're legacy broker-dealer managed account platforms or technology tool vendors, all of which who are retrofitting their RA service model on top of their legacy businesses. Adhesion's service model fully respects and supports your role as the sole relationship point, the wealth management point with these clients. You are their financial guide, you're directing their investment strategies to help attain their financial goals, and it's Adhesion's role to implement those investment strategies on your behalf. Like Marc, we believe that specialization is an important or a critical requirement of successful growth strategies for advisors going forward. That advisors should laser focus on the servicing and the building of their client bases, that advisors focus on defining their unique brand, their differentiation, that advisors laser focus on what they do best and figure out what that is, and then leverage outside specialists for everything else. Marc has used a number of metaphors. One that I've used often is about swimming in your lane. Like swimmers, it's hard for advisors to be successful if they're all over the place, and that's kind of our mantra of how we view the industry as well. Next slide, please. So, what does this comprehensive investment solution entail? Well, there's a lot to it and probably a lot of different ways of presenting it. I personally prefer to talk about Adhesion services in the context of the benefits provided to you, one, your clients, and ultimately your business. So first, back to focusing on what you do best, we view our mission to help advisors keep their focus elevated on their clients and on their business. With this mission in mind, Adhesion's platform provides the tools and resources to help you architect your unique investment solutions, to help you guide your clients into appropriate investment strategies and to customize them as needed, and to provide you with a powerful online dashboard, or some people can view it as a command and control center, to help you oversee the delivery of these strategies to your clients. And probably, perhaps most importantly, is that this online dashboard is a data mining tool for you to mine your book of business for specific exception conditions and opportunities that should get your attention. That's the elevating your focus. Second, as you work to build your differentiated brand, Adhesion helps with enhancing the client's experience with your firm. We enhance that experience through an innovative and powerful delivery vehicle, that of the Unified Managed Account. We enhance the experience through interactive online tools that help engage your clients in the investment process. We enhance the experience through value-added services like tax overlay, which seek to improve your clients' after-tax returns. And we enhance the experience through online performance reporting designed specifically to help project your distinctive image and provide clients with a clear view of the value that you are providing them. And finally, and fundamental to any growth strategy for an advisor, Adhesion provides institution-level infrastructure upon which your business gains scale, efficiency, and added security. First and foremost, and this is an important point, first and foremost, when you are working with Adhesion, you immediately leverage the massive investment we've made in experienced professionals, processes, workflow, and advanced technology. Then beyond scale and efficiency, there is enhanced security of your client data, enhanced business continuity capability for your firm, and an improved quality control regimen in the investment process. And then, as an added benefit that more advisors are beginning to recognize, is that of managing compliance risk. Our institutionalized processes consistently implement and document your investment process, something that we all are hearing more and more that the SEC examiners are very keen on to see, and something I'm sure Mark was referring to in his culture of compliance that he attributed to evolving businesses and the others who are approaching that. Jack, next slide, please. So, who do we serve? You know, I'm often asked the question about what firms are ideal candidates for Adhesion. And, you know, as Mark went through his segmentation, simple attributes such as, you know, AUM or revenue, level of revenue or practice type just don't cut it very well. The one common attribute I always come back to from all our client base is that they have a defined or at least evolving strategy for accelerating the growth of their firm. And I often refer to Mark's segmentation of between evolving businesses and tweeners. I think his characterization of these firms, the types and the attributes that comprise them, are pretty dead on to, if I look at our client base, what our clients look like. And as I think about Adhesion's basic clients, I would very much classify them as, you know, evolving businesses with perhaps as tweeners, evolving side of the tweeners that are actively taking steps into becoming evolving businesses. If I were just reflecting back on probably, you know, a few client firms I've even spoken to over the last week or so, as I think about them, each of them definitely had a defined niche or specialization to which they're driving their growth activities. Two are regularly and actively adding small advisory teams to their practices. So from that perspective, our client support teams are helping them in a continuous mode of facilitating the onboarding of these teams. And as a byproduct of this, their client base is spreading across multiple custodians, the complexity of which is being masked by Adhesion as their outsourced service model provider. Another two are actively extending their services to other firms in an investment strategist capacity, and where Adhesion is the delivery mechanism and the fee collection mechanism for these services to other advisory firms. So we're seeing a nice wide variety of growth strategies that are coming from these firms. As Mark said, they're all entrepreneurs. We're entrepreneurs. We see eye to eye, and we're enthusiastic about the different growth strategies that we see these other smart entrepreneurs starting to take. Let me next slide, please. Let me just maybe wrap up here really quickly with sharing an observation. One that I guess supports Mark's less than rosy prediction for the fate of many tweeners and books of businesses. Today we're seeing a disconnect. we see this often as we're speaking with, when we're out there speaking with other advisory firms, and it's about, many still see their primary value delivered to clients as being investment managers. The consumer research will tell you that, the majority of clients out there want holistic wealth management services from their clients. However, advisors, on the other hand, a very small percentage of them actually deliver that kind of services. As I said, they're predominantly basically focused on investment management and not wealth management. And they do this, and they hold on to this, and this is a bit of a legacy model that they hang on to, is that despite clear evidence that providing wealth management is a successful model, as far as success of firms, as productivity, assets under management, revenue, they're still holding on to this thing. Next slide, please. As such, the demands of being an investment manager are in fact acting against their best interests. It's pulling them away from their clients. On average, these kind of advisors only spend less than half of their time on client-facing activities, while diverting almost half of their time to the implementation side, to portfolio management and its related operations. That puts them at a huge competitive disadvantage to the evolving businesses that Marc turned about, where they are dogmatically focused on building their businesses and expanding their client bases. So, what all these observations point to, and Marc's had a number of conclusions, and we see this a little bit as ourselves, is that there's a need for a new operating model in this brave new world, as Marc calls it. An operating model which drives a client-centric, not an investment-centric growth strategy. And for many, this is a difficult paradigm shift to make. It's not an incremental tweak to how they operate today, how their legacy business operates today. It is a comprehensive evolution of their business, and change is difficult. But however, it's extremely important. And it's for advisor firms like this who are seeking to make this change, that we have positioned Adhesion Service Model. That is what we refer to as the Adhesion Partnership. So, as a brief overview, that's where we are. I hope you got from this is begin to see what we internally believe about ourselves very firmly, that the Adhesion Service Model is a unique proposition for RIAs who are trying to execute on their growth strategy and evolve their businesses. With that, I hope it didn't take too much of your time. I'd like to thank you for indulging me in these last few minutes, and I'm going to turn this back over to Jack for any further Q&A.
Awesome. Again, if you have any questions for Michael, you can contact Adhesion directly or use the question box in the go-to meeting space on the right-hand side. We are running a little bit long today, so we'll take your questions directly when you get a chance. Just to wrap up real quickly, on November 20th, Bob Veras will be joining us. There is a product briefing for those of you that would like a little bit more detail about the Adhesion partnership. Ty McDaniel is going to be hosting that on October 29th, and you're going to get additional information about both of those in the follow-up emails. This has been recorded. You will get a link so you can listen to the recording. You will have links to register for future events, and we'll be keeping you informed about what's going on that front. You guys have been a very patient audience. I'm overwhelmed by the number of folks that are still on this line. You've been extremely patient, and I think it speaks to the subject matter. Marc, thank you very much. Excellent job. Michael, thank you very much. Excellent job as well. And on behalf of Adhesion Wealth Advisors Solutions, we want to thank you all very much for joining us today, and we look forward to seeing you at our next Building Exceptional RIAs webinar. Thank you all very much, and have a great day.